Hey everybody, how we doing? Chase here. So let's talk about today's potential trade. Like I said, it's a riskier trade, okay? And let's look at why. Let's look at the last time we had a ranging situation like this, right here, okay? So we had a ranging situation like this, and we said, okay, this is sort of a chop box type of scenario. You could just put a box around this and call it a chop box. It's all choppy price action. And, if we were to use the strategy that we would want to use today, we could say, okay, well, a 1 hour close. And let's see what this looked like on the 4 hour actually. Okay, so we could say, look at how well defined this level looks, right? We're getting all these, rejections and all candle closes inside the two levels. Then we finally had a candle close, 4 hour candle close outside. Now, the sad part is we saw some, manipulation here. What happened was this enticed breakout traders into the market. They ran the stops for people who utilize tight stop losses, and then it went up, okay? So this does not always happen, okay? This actually happens less often than we see here, okay? So this is happening less than average of the time. So if you see any type of plays like this, that is not really the norm. That's some, sort of disgusting manipulation, we could call it, okay? So how to trade something like this, and let's talk about we could see here all these defined levels on the 1 hour, right? We're seeing all these rejections, candle closes. The only anomaly we have is this right here, and this, but I'm not even really looking at this because this is just fake FUD, and this is futures expiration, some whales buying back or whatever. I consider this whole thing just one manipulative move. The big players probably got them to publish this article, and then they bought it back down here. Okay, call me tinfoil hat, whatever you want. I know that there's manipulation in the market, so I'm going to call it how I personally see it. Alright, so we have this solid range right here, and I want you to think of it like this, and I'll show you why it's a risky trade. Alright, so down here we have what we're going to call the, we'll use our analogies here. This is the bullish stronghold down here. This is where all the bulls currently live. Okay? Bulls live here. This is their their home. This is there's a huge brick wall around this area. They have all their food here. They have all their supplies here. All their resources are right there. Okay, that's where the bulls live. Now this is where the bears live. Okay, over here it's the same situation. The bears have all their resources here, all their first aid, all their food, all their weapons, all their armor, all that's over here. So this is where the bears live, this is where the bulls live. These two zones are going to be, if the bulls want to take over where the bears live, it's going to be a very tough battle, okay? Now this area here, this is where the war is going on. So this area is an area of war. Okay, and in this area we have two other areas. We have the right here. This is the bullish sort of front line area. Okay, so this is where the bulls have like their first aid station. They have their rations, things of that nature. They have some weapon reserves. They have a little bit to they got some sandbags, they got some protection here. This is a minor station for the bulls, okay? And this is the minor station for the bears. This is where the bears have their sandbags. They have they have some food here, they have some medics here, they got some, supplies here. And what they're trying to do, but both of these areas here, these are weak. These aren't strongholds, right? This isn't like their castle. Like this is the bear castle. This is the bull castle. There's a huge moat around it. There's a big brick wall. There's a big brick wall over here, big moat around everything, so no one can get in. The horses are here. They have all their supplies in these areas. And this is the area of war, right in the middle, right in the purple zone. And the two orange zones are where the first line of support is. This is the first line for the bulls. This is the first line for the bears. So either of these areas can easily be taken over once the momentum starts to move. But as that momentum moves, understand that we could still face resistance from where most of the bears actually live. Why do the bears live here? They live here because all their stop losses are right above this area. Same with the bulls. Anyone who longed from this area, anyone who made an investment in the bull fort, they're protected right under this area. So if this area gets broken, everything that a bull put into this area, they have to cut their losses, and they have to run for cover. They have to escape because the bears would be taking over their area. The stronghold has been defeated. Okay, so I hope people like these analogies. I'm sure some people don't like them, but I really do feel like it makes a great case as to what type of risk reward you're seeing and what type of risk there is here. Okay, let's look at some potential trades, and this is important when it comes to these areas. Like I said, if you were looking for a risky trade, either a 1 hour candle close outside of the formation, 1 hour candle close outside of this sort of chop box area we have here, or a 1 hour close outside of the chop box area we have up here. We can see the resistance levels. Okay, let's clear out these boxes, make it a little cleaner. All right, so you can see how these areas have been respected. We'll leave that. You can see how these areas have been respected, and what we're going to do is, if there's a breakout upwards, remember, if the breakout is something like this, if this candle just shoots to the moon here, there's no entry this far away. Okay, that's too far away. That's that's 90 points away from the nearest medic station, so to say, the nearest front line. Okay, so what that means is that if you're looking for if you get that potential breakout and you see a long here, okay, this area that used to be the bearish front line. Okay, this is where the bears had their first line of defense. Well, this now turns into the bulls' second line of defense, so to say, or this becomes the bulls' first line of defense, and this area down here now becomes the bulls' second line of defense. Yeah, that's how it would be. So if we get a breakout above here, becomes the bulls' first line of defense, this is their second line of defense, and this is still where they live. Okay, so the troops, the bull troops, are moving upwards. They're moving up with strength. This area is now strengthening as support, and this area is becoming support. Okay, so they're taking over. The bulls would be taking over the bears' first line of defense. So what we can do position wise is we can hope that it becomes support. So if you get the breakout, and let's say the breakout is right here, you simply put your stop loss back inside the area right here, 40 to 50 points, not even a big deal. And you could target the first area where the bulls live, which is right around here. You're getting about a 2.5 risk reward. Is it a great trade? Not really, okay? But is it a potential risky trade? It certainly is. And I want to present these ideas to you because I know that, some people in the group are definitely thinking, well, where the trades, like I said, we did have, well, first we had Trooper's trade that did go 80 points in success if you close for profits. And then we did have my trade as well, which went for 150 to 200 points if you closed in profits. And especially on my second trade, I guided the whole thing, so there was literally no chance for anything but profits. But regardless, I understand the nature of people wanting to find trades. So what I'm going to do is show you a riskier trade. Okay, so here's the trade opportunity. It's on the breakout. Your stop loss is back inside. Understand that manipulation can occur, and you can get wrecked with this type of strategy. You could simply get stopped out. Okay, it's not any type of confident strategy. 2.5 risk reward. It's decent. Same thing applies on the other side. If the bears close below the line, and this becomes the bears' first line of defense, and now this strengthens for the bears, and then the bears are still living here, you could set your stop loss here. You can set your stop loss back inside, enter upon the breakdown, and target the area where the bulls live right around here. That's about a 3.9 risk reward, or you probably got to target the top of these wicks, sort of. So we would be saying about a 3 risk reward. So not too bad right there. Now though, if you are a let's say experienced, patient trader, right? What type of plays do you really see here? In my opinion, we're smack dab in the middle of the range. And so let's look at what type of risk reward we're seeing here, because a lot of people are talking about, oh, well, what risk reward is good, what risk reward is good. Well, look at this, smack dab in the middle of the range. Bulls live here, bears live here. It doesn't matter which way you target. If you open a position from here, you have to set your stop loss past where the bears live and target where the you would target where the bulls live. Okay, that's a 1 risk reward. Okay, 1 is not going to do you anything in this game. Now let's go for a long position from the dead center here. Long from the dead center. Where does your stop have to be? Your stop has to be below the farthest point where the bulls live, to where the bull stronghold has finally been taken over. Where do you target? You target where the bears live. A 0.064 risk reward. That's absolutely horrible. Long term, you'll never be successful with those type of risk rewards. So what are the type of trades that you want? Where is the good risk reward? It's very simple, guys. It's what we've been waiting for. Do we want a long from where the bulls live, or we want a short from where the bears live? But obviously we want to look for some type of, like a bullish SFP or a bearish SFP, or we want to find some bullish divergence, or we want to find some bearish divergence. When we get to the area, we want to look at the smaller time frame, and we want to make sure that the stronghold isn't actually being taken over. You can't always just short the bearish area. We could do some, volume spread analysis while we're in there, see what type of candles we're getting, put all those factors together when you get to an area like that. Okay, because you have to remember, it's possible that if this area breaks, chain stop losses occur, and remember that the more times you're going to test supply, the more likely supply is to break, not the stronger it becomes. Okay, so what type of trade can you find? The bulls live here, so you long from the middle of the bulls area, probably somewhere around here, and your stop loss is right below where the bulls live. And of course, like I said, typically I would not have preset levels here. I'll wait and see, because what if the level's manipulated for a bullish swing failure pattern? Okay, go watch my video on liquidity and bullish SFPs or bearish SFPs. All right, what if there's a bullish SFP here and we get a nice 1 hour close on a bullish SFP? We can be much more confident. We could set our position like this with a nice tighter stop loss below that wick, and we can target the middle of the range, and we could target where the bears live. And look at how this risk reward just starts spiking to really strong levels. That will give you long-term success. Same thing goes for the bear side. Let's flip it over there real quick, show that example. If you were to flip it over here, we come up, we get a bearish SFP. Same exact thing. You get your short position open. Let's even talk more. You get a bearish SFP here, okay? You get a 1 hour, comes and pierces this. It closes back below. At the same time, you made a high here, and then you made a high here. So you're getting that, but on the RSI, you're getting this. You're getting a higher high here, and then for the next one, you're getting a lower high. So you're getting a bearish divergence right here as well. Let's say on that 1 hour close, you get a very bearish candlestick. Okay, you get a 1 hour inverted hammer, or a gravestone doji, a shooting star, whatever you want to call it. Okay, and now you're combining all these things, and you're thinking, oh wow, well, this should be a really good trade. Then this is a high confidence trade, and not only is it a high confidence trade, but let's look at the risk reward we would have. So it's a high confidence trade. We put our stop rate above that level, say 60 points, 70 points. And all of a sudden you're targeting the middle of the range for 4.2 risk reward. You're targeting where the bulls live for 8.7 risk reward. And imagine that the bull area breaks, you're looking at insane risk rewards. Okay, you're looking at 13, you're looking at 20. Okay, those are the type of trades you want to make. And like I said, for the people who are more anxious, who are a little impatient, I'll show you some other opportunities. It doesn't necessarily mean I'm going to trade them. I'll show them to you, and I'll show you the risks behind them and explain everything that is involved with them. And then I'll show you what good opportunities look like, which is what I just showed you. Okay? Thank you very much, everybody. Have a great day.